So, did you know that some of the absolute most profitable businesses on paper anyway have been forced to close their doors forever simply because they ran out of cash? It's crazy, but it literally happens every single day. You might look at your business, see customers walking in, sales happening, money rapidly moving through the bank, and it feels fantastic, right? But here's a critical and honestly kind of scary reality check. Strong revenue alone does not guarantee you're actually financially healthy. You could have record-breaking sales and still carry way too much debt, hold way too much unsold inventory, or just lack the literal cash on hand to pay next week's bills. Your revenue is absolutely important, for sure, but it just can't answer the most vital questions about your company's actual survival. And, well, that is exactly where the balance sheet comes in. Today, in this explainer, we're going to demystify the small business balance sheet step by step. I know for a lot of entrepreneurs, accounting feels incredibly intimidating. Kind of like a foreign language you just don't have the time to learn. But I promise you, by the end of our time together, this document is going to become your new superpower. Even if you've never taken a single accounting class in your life, you're going to know exactly how to decipher what your business owns, what it owes, and what's actually left over for you as the owner.
Okay, here's our quick roadmap for today. First, the financial health snapshot. Second, the golden formula. Third, a real-world example. Fourth, how to analyze numbers. And finally, spotting early warning signs. All right, let's jump right into step one, the financial health snapshot.
So we need to begin with the absolute simplest definition of what this document actually is. Think of your balance sheet exactly like a photograph taken on a very specific date. It's not a sweeping, epic movie. It's a frozen moment in time. Whenever you look at it, it answers three incredibly essential questions for that exact second. What does my business own? What does my business owe? And what value is actually kept for the owner?
The easiest way to grasp this is by comparing it to your other financial docs. Think of your income statement like a video. It shows all the action, all the moving parts, the progress over a whole month or a year. But the balance sheet, that's a frozen photograph of right now. It's exactly where your business stands at this very second. The video shows the journey, but the photograph shows you your exact coordinates on the map.
Moving right along to step two, the golden formula.
Let's look at the engine that drives this entire document. We're going to break down the three major sections through what we call the golden formula. This is the one rule you absolutely must remember. Assets equal liabilities plus equity. In plain English, what the business owns must perfectly equal what it owes to others plus the owner's remaining interest. Think of this as the ultimate scale of truth for your business. Both sides have to balance out perfectly. If that scale tips even a penny out of alignment, well, something is fundamentally broken in your accounting.
Let's look a bit closer at the first part of that equation, assets. This is the stuff of financial value that your business owns or controls. But you've got to separate them into two distinct categories to really get it. Current assets are things you expect to easily convert to cash within 12 months, like bank cash, inventory, short-term investments. Non-current assets are held for much longer. Think delivery vehicles, manufacturing equipment, a building. It's absolutely vital to know the difference because, let's be honest, you can't exactly pay your plumber with the steering wheel of your delivery truck. Knowing what you can actually spend is pure survival.
And that brings us to a hidden danger we call the liquidity trap. It's kind of the ultimate paper billionaire illusion for a small business. Imagine your business has 20 grand in cash and 80 grand in inventory. Your balance sheet proudly shows 100 grand in total assets. Sounds amazing on paper, right? You feel rich. But actually picture that. If that $80,000 is stuck as unsold inventory just gathering dust in a warehouse, you don't actually have the cash to pay tomorrow's payroll. You simply can't afford to only look at total assets. You've got to understand how quickly those assets can actually become usable cash. The exact same illusion happens with accounts receivable. Say you sell $15,000 worth of product to your best customers on credit. You made the sale, delivered the goods, but they haven't paid the invoice yet. That 15 grand is sitting there looking really pretty as an asset, but it's just an IOU, meaning it is not usable cash in your bank account yet. This explains perfectly how a company can look incredibly asset-rich on paper while simultaneously sweating through a massive cash flow panic. Rounding out the rest of our golden formula, we've got liabilities and equity. Liabilities are just the obligations you need to pay. Bank loans, supplier invoices you're probably dreading, credit cards, taxes. Just like assets, we split these into current liabilities, due within 12 months, and long-term ones. Equity, on the other hand, is what's left for you after those liabilities are deducted from your assets. It includes your original owner contributions and any retained earnings. And if you're wondering, retained earnings are just those hard-fought profits you bravely decided to reinvest right back into your dream. All right, on to step 3, a real-world example. Let's actually put these pieces together. I want to walk you methodically through a concrete example. Imagine a fictional business owner named Sarah, who runs Bright Path Cafe. If we tally up her assets, she has 25 grand in cash, 15 grand owed to her in accounts receivable, 30 grand in coffee and food inventory, and 50 grand tied up in espresso machines. That's a total of 120 grand in assets. Now, on the flip side, she owes 15 grand to suppliers and 35 grand on a bank loan, so total liabilities are 50 grand. Let's solve the puzzle. What's her equity? Take the 120K in assets, subtract the 50K in liabilities, and you're left with 70K in equity. Just like magic, the scale balances. 120 equals 50 plus 70. Sarah's got a healthy, balanced snapshot.
Now for step 4, how to analyze numbers. Reading numbers is great, but analyzing them to make smart decisions, that's where the real power is. Whenever you open your balance sheet, run it through this simple 5-point stress test. 1, does it actually balance? If it doesn't, stop what you're doing and investigate. 2, check cash. Exactly how much money can you access today if an emergency strikes? 3, compare current assets with current liabilities. Do you have enough short-term value to cover short-term bills? 4, check your debt. Are you getting too dependent on borrowing? And 5, compare periods. You always want to look at directional trends, which we'll touch on in just a sec.
Once you master those basics, you can easily level up by using these 3 formulas: current ratio, working capital, and debt to equity. If these look intimidating, let me ground them for you. If you ever want a business loan, that debt to equity ratio is the very first thing a bank officer looks at. It tells them how heavily you rely on financing versus your own cash. The current ratio gives you a quick view of your short-term liquidity, and working capital tells you if you actually have more current assets than obligations. Keep in mind, there's no single magic number here. Healthy targets depend completely on your specific industry. And finally, step 5, spotting early warning signs. Let's see how this document can be a protective shield for your business. Watch out for these red flags. Is your cash consistently dropping month after month? Is your short-term credit card debt steadily climbing? Here's a huge one. If your inventory is growing way faster than your actual sales, that's a blaring siren that your cash is getting trapped in cardboard boxes. Or are customers taking longer to pay, meaning receivables are spiking? Look, the goal isn't to panic when you spot these. The goal is to use them as an early warning radar to catch minor problems long before they derail everything. And this is exactly why regular review is totally mandatory. Remember, a single balance sheet is just a photograph of today. But when you line up January, February, and March side by side, suddenly you've got a motion picture of your financial trajectory. Comparing these over time reveals the trends that dictate exactly how you should hire, when you should borrow, and if you can afford to expand. You really do not need to be an accountant, and you definitely don't need to be intimidated by the terminology to run your business safely. Just remember that assets equal liabilities plus equity. It all comes down to 3 deeply simple things: what you own, what you owe, and what you keep. If you understand those 3 buckets and check them regularly, you're taking the control back from the numbers. So that brings us to the ultimate question I want to leave you with today. Think about your own business right now. If you pulled your balance sheet today and we sat down together to break it down line by line, what hidden story would those numbers reveal about exactly where your company's future is heading? Thanks for joining me on this explainer, and keep diving into those numbers.